It's all over the news. The U.S. mortgage industry is undergoing its most significant credit scoring overhaul in over 30 years. As of April 2026, federal regulators have officially implemented new scoring models to break the decade-long monopoly of classic FICO scores to the mortgage market. All right, let's break it down. What does this really mean? First, it's really important to know that the mortgage industry has been using classic FICO for, oh my God, as long as I've been in the mortgage industry, which is over 30 years. And the challenge with that is these models are very outdated and in some way just haven't evolved, haven't modernized with credit risk assessment, being able to report on utilities, being able to report on rental payments and things like that. So this change is vast, and please know that it's not going to just like flip the switch and be in the operation mode now. It's going to take time for the mortgage industry, for Wall Street, for the investors, for Fannie Mae and Freddie Mac and FHA to be able to operationalize the change in the credit formats. So going from the classic model, this announcement now allows for lenders to use the Vantage 4.0 or the FICO 10T. And you might be wondering, well, what the heck is the difference? One of the main differences between the classic model and these two new models are they're going to allow for trended credit. And trended credit is unique in the sense that it's going to take over a period of time what your payment history and profile looks like. Whereas in the classic model, if you've paid on time for 20 years and you have one 30-day late, it's that one 30-day late that's impacting that credit score with regard to the last 2 years, let's say. In the new trended credit models, we may see a benefit to those that have paid their payments on time over time, hopefully with a less of an impact of a little glitch on maybe one 30-day late because you went on vacation or something happened and you just weren't aware of it. So that whole trended credit aspect is going to be new for the mortgage lending industry. These two newer credit scoring models will incorporate rental payments and utility payments. So it's going to help you from a credit scoring standpoint because now those items are not factored into the traditional classic scoring models that are being used from a mortgage lending standpoint. The other thing here is that if you have no credit, and let's say you are just starting out on building your credit profile, it normally takes under the classic model 6 months of payment and of that account being opened before it will report on your credit reports. With this trended version, with these two new models, that is supposed to happen after 1 month. So again, it's going to get you a score. It's going to get you on your way of being able to build a credit profile and a credit score quicker that potentially will lead you to that home ownership goal. The challenge is this is so new, and we must remember that mortgage lending is based on risk. So for example, maybe your client has a 640 credit score now with the classic model. With the new, one of these new models, maybe the credit score is higher or lower than that. What's the impact to the interest rate? Because interest rates are based on credit scores when it comes to mortgage lending. The cost of mortgage insurance is based on credit scores. There's still a lot of unknown. So while this is exciting, it's going to take a little bit of time for lenders to get their arms around it, for, again, the agencies, Fannie Mae, Freddie Mac, FHA, to get their risk assessment arms around it, to update their selling guides, to then be able to determine when loans are sold into the secondary market, what's the pricing model there? Are they going to accept these two different credit scoring algorithms and models, or are they going to be using the old version? There could be a premium or a pricing adjustment that the lender or the investor, or let's say Fannie Mae, Freddie Mac, or FHA is going to surcharge based on one of these newer credit scoring models because they are newer and there is just no track history. So more to come on that. We don't even know what that looks like right now. So a lot has to happen. And I'm sharing this with you just to calm and bring a little bit of insight that this isn't going to happen overnight. But it is exciting news. More to come, but know it's out there. The industry is working on it and trying to get their arms around it so we can bring it to market. So it's progress and it's exciting. No matter how these changes evolve, we would love the opportunity to work with you and your clients. We'd be happy to put together a credit game plan for your buyers. Call or text our home loan hotline at 480-725-0150 or schedule a quick call with us at the link below.